Well, let's get straight to our next guest then. We have Luke Bars, the Managing Director in Fundamental Equity within Goldman Sachs Asset Management, who is in India with clients for the Goldman Sachs India CIO Tour. Hi, Luke. Good morning, and thanks a lot for joining in on the show.
Well, morning. Thank you so much for having me.
Let's start off with what's top of mind, Luke. What is investor sentiment like post the Trump win? And what does it spell in terms of asset allocation, particularly in developed markets? If you could give us the trade-off, developed versus emerging markets post this Trump win.
Perfect. So firstly, look, thank you so much for having me and then hosting me in this fantastic country. We've got 25 of our largest clients here for the week, and they have been overwhelmed by the opportunity we have in India. Now, to answer your question directly, there is optimism across equity markets. We've seen a strong uptick in sentiment that is underpinned by the growth cycle we're expecting to see in the US, the possibility of further reform in the US, and the hope that that drives earnings growth, not just in a concentrated subset of large and mega cap names in the US marketplace, but also across the smaller mid cap space, where we're seeing a lot of that broadening of growth. Now, I think to answer the question of emerging markets versus developed markets, I think it's a very difficult one because of the heterogeneity we're seeing across the EM space. I would say selectively, markets like India, where you have the potential possibility of further acceleration of advanced manufacturing in the China plus one scenario, post a US election, where the relationship with the US we think will be very strong, is very compelling. But I think there's other parts of the emerging market space where the possibilities are maybe a little bit more challenged. So you have to be selective around the individual businesses you're buying, not just trying to think about the short-term macro cyclical drivers.
Okay, all right. Luke, give us some more clarity then. How do you see the equity allocation to emerging markets, particularly India? I'll tell you why, Luke, because everyone's sounding very, very optimistic on the big opportunity in India and the structural story here in India. But the FIs, they have been selling lock, stock and barrel, close to around $12 billion in a matter of 45 days or so. And that's a little bit worrying. So your take?
Well, so I think what we have to separate is the near-term cyclical allocation decisions from the long-term strategic decisions. And the clients we have here with us today and this week in India are here to assess the long-term strategic opportunities. And I think what we've heard through this week is this might not be India's decade, but this is India's century. And so we're seeing a huge amount of opportunity for people to put capital to work across asset classes in India, in the private space, in the public space, and see meaningful return potential. Now, to answer the question of the more cyclical dynamics, why we've been seeing selling pressures from FPIs, I think clearly, as we went through the back end of the summer, valuations became a little bit more lofty. Yes, the earnings story is there. We're going to see 15% earnings this year. Yes, we have visibility on growth over the next decade, which is highly compelling. But India trading at 23, 24 times forward earnings starts to feel a little bit lofty. And so we've seen a natural cycle of profit taking that, let's also remember, coincided with the big stimulus we saw in China. So for some of those larger global emerging market or global equity allocators, needing to cover some of that China risk led to a little bit of a pullback. But I don't think that changes the long-term strategic mindset, which is hugely favorable towards India.
All right, Luke, if in case there had to be money that had to moved out of India because of the high valuations and moved into China because of the stimulus as well as valuation support out there, do you think bulk of that hot money move has happened? We're talking about $12, $13 billion in a very short duration. Or do you think there is more pain in store? I ask you this because the FI allocation to India, FI ownership in India as a percentage of the total mix has come down to around 18.5%. And that's the lowest I've seen in the last 10 years.
Look, it's not our expertise to take those short-term top-down calls, but our sense is that hot money has moved because of the stimulus in China and because of the valuation in India. And so we're now back at a much more reasonable level. Multiples today at around the 21 times forward earnings feels like a very good starting point. It's not cheap, but given the growth potential, it feels like a very good starting point for long-term allocators into the market. And I think when we look at that FPI exposure, and we couple that with also what we're seeing in terms of incremental buying from domestic retail investors as that becomes a bigger part of their overall portfolios, we think there's a structural uptick in not only just the allocation to India that's coming from international and domestic investors, but also just the ability to capture some of those growth opportunities. We see that IPO volume come through.
Luke, I like what you said, right? India is a structural story. It's not the decade we're talking about for India. It's the century that belongs to India. For someone like me who allocates most of my money to equities, well, I'm feeling quite good about the longer term with regard to the India story. Now, within themes here in India, What are the themes you all are looking at? What's looking exciting? The financialization of savings is picking up pace. You have brokers, exchanges, all of them doing quite well out here. Per capita income of an Indian has only been moving up, and it's set to move even higher. How do you play a couple of these themes? What are the sectors, your top bets here in India? Some things that really excites you.
Yeah, so maybe if it's okay, I'll give you a tiny bit of context. When I first came to India maybe 20 years ago, the message we heard was roti kabdo makan, that aspiration to improve your standard of living, start to buy simple, staple, discretionary products. And that's still there. That aspiration is still there. But the mechanism for how that's being delivered is changing. The digitalization of India, both through the UPI scheme, through some of the fast delivery schemes, that has really started to drive a change in that mechanism. And I think the aspiration is also changing in terms of how people are spending that discretionary income. So as we're seeing that wealth creation and that increase in disposable income, especially across the urban centers, that younger generation, the 750 million millennials and Gen Zs that we see starting to explore experiences alongside those simple products, that's a very exciting space. Again, you've got to think about it in the long-term context and look through some of the nearer-term multiples. But again, even on that front, we've seen a pullback that makes the entry point very compelling.
All right, Luke, I'm just going to throw this at you. As a house, do you all have a view on the dollar index? From an India market perspective, that's proving to be a pain point. A dollar index that was closer around 102, just I think 45 days or 2 months ago, it's at around 106.6. And from an India market perspective, that's not seen very well. If you could comment on that?
For sure. So look, I think post-election in the US, we've obviously seen the yield curve back up a little bit. We've seen this belief that we're going to be higher for longer. And so that's put a little bit more underpinning to the dollar strength we've seen over much of the last decade. And I don't think that's going to reverse materially in the near term. I think we are going to see this fiscal agenda in the US that will continue to drive a deficit that puts us in a position where rates might be at that more sticky, elevated level for a period of time. But what I would say on India, and I think this is critical for people who are looking at the market today, is reflect on that historical context. The fiscal position in India is so much stronger today than maybe when we were 10 years back, when we think about the Fragile Five and how India was being viewed in that context. And then also put into context the fact that India is now becoming a real leader in advanced manufacturing. We're just at the start of that. And so to the extent that drives the capital account position as India starts to really take share of the export market, again, we think that has a good underpinning for the long-term strength of the Indian economy, but should also underpin rupee. Not that we see meaningful strength in the near term, but it shouldn't be something that destabilizes the long-term opportunities that across those risk asset classes.
Encouraging thoughts, Luke. Thanks a lot for joining in. India's a structural story. It's got a long runway from year on. And post that recent correction, hopefully, bulk of that FI hot money has moved out. Well,